Today we have a very interesting topic, and it's about the stock market reaction to COVID. I mean, invested by stock market. So obviously, this is a very finance topic. The methodology is also very finance, event study methodology, and we have seen quite a lot of different things during COVID. At least I heard there is a fear index during COVID. So they measure, people's psychological the level of fear. So, but that means everything will be reflected in the stock market. So, and that's why I can imagine the topic is very popular, up to date, and using COVID as a natural experiment to check investors' reaction. Yeah. So we have Meng. Did you? Okay, it's already. Oh, so we have actually. You see the co-authors here. We have Ali, Tolu, Jaideep, Kemi. Basically, they are all our colleagues from School of Finance and Management. Ali is our third-year PhD student in accounting and finance. And Kemi has moved on now to Aston Business School, but Kemi was with us a couple of years ago, So we have Jaideep. I saw Jaideep. We had a small introduction about Jaideep, and I made sure that Jaideep became a reader now on our advertisement rather than senior lecturer. I apologize for that. And Jaideep is a reader in finance at the School for Finance and Management. And we have been working very closely on many different tasks. And Jaideep got his PhD in finance from, I think it's Canadian University, McGill University. And he, of course, got his master, his bachelor degree. So Jaideep is an expert in risk management, and that risk management covers all aspects of our life, as you can see that, including weather, including governance, including demographic things, and also finance. In finance, we also talk about risk management. So basically, he knows everything about risk management, and that is very good because we are all facing a lot of uncertainties, and we need to know how to handle the situation. And I saw Jaideep listed quite a lot of affiliations, and I'm not going to go through everything. But one thing that I did not see, Jaideep, actually you did not really put up your publications. So as far as I know, Jaideep has been publishing very well, for example, in Journal of Banking and Finance. And as far as I know, the most recent one appeared in a very good journal, Journal of Corporate Finance. So well done for that. And basically, Jaideep is a finance person and specialized in risk management. Ali, as we can see that you have been progressing so well that you are only in the third year of your PhD with us, and you have already produced, worked together with other scholars, and you have produced a very looks like a very professional paper. And as far as I know, Ali, we did not have, but we had quite some contact in terms of, teaching arrangement and things. But Ali has been teaching for the departments, and Ali, you have been teaching well, as far as I know. And as far as I can see, Ali, you also had some industry experience before you started your PhD. So I understand that you two are going to present, and I also understand that actually, Ali, you will have a lot of opportunities today to impress us, you know. And so that's basically what I have. So as I said that, we will have a lot of questions because this is so relevant to us, to our connections, you know. I'm really excited to hear from you. Who is going to start?
I can start.
Jaideep.
Thank
Yeah,
you so
thank
much
you.
for that. Just to sort of, if you can go back to the first slide, Ali. So just in terms of the topic, uh, this, before I sort of proceed, I should say that this paper was is obviously, as you see, it's co-authored with Tolu and Kemi. Tolu is present here today, and uh, Kemi, I don't think she was able to make it. So Tolu and Kemi started this project with Ali a couple of years ago, and then I came onto it later, and so that's why it's not a risk management project, but it's nonetheless very interesting from an accounting perspective, and it's a bit kind of opportunistic in the sense that it's about it's doing something that would have been difficult to do in other circumstances if it hadn't been for the COVID pandemic. So Ali, if you could move to the next slide, please. Thanks. So I'll just give you a very, very quick motivation and background, and then I'm going to hand over to Ali, who's going to very proficiently explain exactly what goes on in the paper. So just in terms of trying to understand the question, right? So it's about investor responsiveness to earnings announcements. And if you say, oh, how come you're even still talking about that? I mean, there's been papers since the 1960s written about this question, and there's a massive literature. But it's a very open question still. There's lots still to be learned about the way in which investors incorporate information from accounting releases of different forms. And so this, particularly the earnings return relationship, there's the starting from Ball and Brown's paper in 1968, a couple of other papers at that time. If you look at the most recent sort of editions of the top journals in accounting, Accounting Review, Journal of Accounting and Economics, Review of Accounting Studies, the Journal of Account. All of these have recent papers asking the same, studying the same question. So it's still a very relevant topic, and they've got different dimensions. So there's still a debate on about how informative earnings information is, and also uh, there has been some discussion where there was like a premature assumption that earnings are becoming less important in the decision in which by which sort of stock prices are determined, and people are looking for alternative sources of information. Then there was sort of a kind of a reversal of that argument from the point of view that the disclosure regulations could change, the quality of the information could change. So there's international comparisons. There's a relevance of the earnings related information coming up from the idea that there's some companies that don't necessarily make a profit today, but it's their expected growth, which is determined on a completely different kind of business cycle, sort of business strategy logic that is going to determine what their prices are. So the connection between earnings and stock prices starts to become a little bit looser from those based on those arguments. Now, there's all this kind of time variation, different kinds of questions that people have asked, and all of them, whether it's at the time varying level, so the average impact of earnings, or whether it's about the earnings information from different types of companies. So whether they have high betas or low betas, or whether they have better quality disclosures, and so on. How do investors incorporate this information? This question still sort of is an open one. So the first thing to say is that it's a valid question to ask. That's our first motivation. Secondly, Ali, if you don't mind, is the sort of the question about quality. And so now here we are thinking about a sort of situation where there's, unlike the typical kinds of information, earnings uh, provide two sets of information. So one is what is the sort of the amount that you can consume today. Think of it as a dividend or an earning, which is like basically your consumption potential at time t, but also some indicator of what the future stream of earnings is going to be like. So for example, if your earnings grow this time compared to last time, you might say that you expect them to grow in the future, or you might not. So understanding what information comes with an earnings release uh, gives you two sets of data. And so this future expectation of the earnings, it has uh, it's formed not only from the earnings themselves, but also from all kinds of other economic information. So, for example, growth expectations for the GDP of the economy and how that's going to translate into the earnings of the firm. So, when we think about the entire information environment, there's a really good paper by Veronese from 2000 in Journal of Finance, which shows that the quality of information has an impact on the way in which stock prices evolve. Now, that model is a Lucas tree kind of model, and it has a slightly counterintuitive logic, which suggests that there's basically no equity premium for uncertainty. Okay, so because it's a single asset economy, uh, it has this kind of surprising logic. But basically, if you think of the interpretation, it just simply says this: if I receive earnings today, and I I can I only have that information and no other information, in the sense that the information about the economy is completely vague. It has a very low precision. Then the only thing I can use to make my decisions about the future are the earnings. Now, if the earnings have fallen, I'm actually more worried about the future, because that suggests that I'm going to need more of the asset in order to hedge future income, future consumption. So, sort of counterlogically, that increases the demand for the asset. On the other hand, if I know about the future from the GDP, I have an excellent precision about the future stream of income and so on, then I don't really care what the earnings are today. I don't sort of rely on them as much, because I can think of them as a short-term consumption covariation rather than sort of the long-term impact, because I already know how I'm going to hedge my future consumption, because I have my sequence of future earnings predicted. Okay, so my the information that comes from earnings can be mostly about now, and can be uh, also very much so the only set of information you get, also about the future, depending on what is the information environment, the quality of the information that's around you. And that's where the question like COVID comes in, because during that time, your information about the overall economy becomes quite vague. Okay, so in this context, there's a bunch of papers that have tried to study this. So how do earnings respond, or how's earnings information incorporated into stock prices during different types of crises, during different types of information environments. But most of these are based on, and we've got a list of them here. Most of them are based either on like how analysts respond to this information, so how they incorporate the sort of information into their forecast, or about sort of crisis periods. So in the sense that the crisis periods that they've identified are typically endogenous and financial. And so if you go to the next slide, Ali, that's what's different about this paper, is that thinking about COVID, this it created a very different type of exogenous source of uncertainty. I mean, if you remember, it was not so long ago, there were discussions about how the economy is going to change. Are people going to go back into the office? Basically, pretty much everything was up for debate. We didn't know how exactly firms are going to be exposed to different earnings patterns in the future. Are all real estate companies going to default because nobody will want an office anymore? Uh, what's going to happen to online working versus working at home? So fundamental economic reorganization was sort of perceived as being possible. And there was a huge range of heterogeneous expectations about different types of firms and how they're going to be exposed to this. But apart from the uncertainty at the level of the firm, at the level of the business, even the information that was coming to us in terms of the quality of it, in terms of the fact that how certain are we about growth? If we get a growth number, how reliable is it? That was heavily in question, and that's basically one of the things that we'll show you later with some data as well. And so, in that context, COVID becomes an excellent sort of way of examining this theory of Veronese and others, where we're talking about learning in stock prices, and if in, sort of investors are learning from different sets of information, how are they responding? So just to sort of recap, what I'm trying to say is that the title of the paper is about investor responsiveness to earnings news, and we want to know, because there's a huge history of trying to understand this, whether this actually changes during a crisis. Some people have argued that it should become less important because everyone would be more concerned about the aggregate economy. So if you were to look at, for example, stock returns, they people tend to think that they will bunch together simply because people only care about the economy. But by looking at it through sort of an event study approach, we are going to ask ourselves how much information is in earnings and how do investors use it, and why particularly this, and this is why the COVID setting is really useful. Okay, so I'll hand over to Ali from now. Thanks.
Thank you. Thank you. So I'll start off with explaining how we went about this. So for this, firstly, we used the UK setting. The UK setting has like primary two motivations. One is it's comparable to the US market, but the biggest advantage is that it's an IFRS setting, which means that it gives managers the flexibility to have some variation in information content. And since we're like trying to explore this variation, we're trying to see how informative earnings are. The UK offers both over here a comparability to the US market and also along with IFRS. So we take the FTSE 350 index, which is like a broad base. It doesn't include only the large cap firms. It also includes the mid cap stocks. So we take 171 non-financial firms. We've excluded financial firms because they would have different leverage characteristics, etc. So we take 171 non-financial firms from the period 2016 to 2022. Now, what we do over here is we divide our data into three distinct periods. One, we call it the pre-pandemic period, the second one, the pandemic, and the third is the post-pandemic. Now, how did we come about defining this period? So we look at what can be the pandemic period. So we have two motivations why we think that this is the pandemic period. So we first start off with the FTSE 350 index. Now, the FTSE 350 index was roughly trading at about 4,100 points in like January, February before the pandemic actually started. Then it declined like other indexes. So it did not revert back to its original or the pre-pandemic value all the way till 2021 quarter two. I should also tell that the index did not operate like it just went to decline. There was this variation that happened in the index. So the first motivation we took that, okay, so we're starting from 2020 quarter two, which is April 2020, and we went up till June of 2021. That's still we can see the index reverted. So like we define this to be the pandemic period. Anything before that, the was the pre-pandemic, and anything after that was the post pandemic. Now, the second motivation why we define this as the pandemic period, if I can go, is this is the UK lockdown timeline. We got this from IFG. So this is the whole picture. I'm just going to zoom this in. So if you see, roughly 26 March 2020 is the date when the lockdown was legally enforced. So we said, okay, end of March is when the lockdown is legally enforced. So April 2020 became the starting point. That was the justification to start from April 2020. And then we all saw, like, we had this multiple waves of like lockdown getting back to normal, but the legally the like all the limits were removed in 19 July 2021. So we said, okay, that like justifies our period, that from 2020 quarter two, which is April 2020, we can go up till June of 2021. That became our pandemic period. That's how we define the pandemic period over here. So now we extracted data from ICAM data stream. That's where we got our financial variables. For economic data, we looked at Bloomberg and Fitch Connect. Now, how we went about it is that we first created our earnings calendar, because this study's primary focus is on looking at investor responsiveness to earnings. So we created our earnings calendar, like after excluding our financial firms and missing information, we had 171 non-financial firms. So we got all their earnings announcement date, we got their earnings data, and we created an earnings calendar over here. One thing that I should like to add is that since for earnings we really took annual earnings, because some firms had, like, let's say, one interim, some firms had two, so they were not consistent. And secondly, annual earnings has been shown in literature to have more information content, so we stuck with annual earnings because all of these firms had annual earnings data. So we got 1152 annual earnings events, which became our earnings calendar. Once we had our earnings calendar, we created an economic calendar. Now, what do I mean by economic calendar? So we followed Hugon et al. So Hugon et al. Look at macroeconomic news from the point of view of GDP forecast. So they argue that GDP is the most comprehensive indicator that markets look at. So we followed Hugon et al. And we extracted GDP forecast from the Bloomberg macroeconomic survey. The Bloomberg survey basically gives out what the consensus forecast is from their screened participants. So we took out GDP news from there. So all firms then were also getting this information about GDP surprises. So we got 27 GDP news forecasts that were announced during our period, which is 2016 to 2022. So this was announced quarterly, and we had 4,548 observations for this. So now we have two calendars. One is the earnings calendar, and the other was our economic or the GDP news calendar. So I'll just briefly define our key variables. So since we're doing an event study, like a short window event study, because we want to isolate the impact of how investors react to news. So we calculated the cumulative abnormal return. We took a 5-day period. Just a quick recap: cumulative abnormal return, we like calculate daily abnormal returns, which is return minus expected return. So we get daily returns, and then we aggregate it over here. So we evaluated different windows. We took a 3-day window, 5-day window, and even a 21-day window, which is done in the literature. We found the 5-day window to be consistent and significant. So for both events, which is earnings and GDP news, we took a 5-day cumulative abnormal return around this announcement date. For earnings, what is our surprise over here? So we calculated our surprise using a random walk model, where we looked at earnings this year and we compared it to the previous earnings, and then we scaled it by its previous price, just to like standardize it over here. For GDP news, following Hugon et al., we looked at what was the GDP growth forecast announced, and we compared it to the actual GDP T minus 4. So, for example, if you have a GDP announcement being made in April 2020, you would compare it to the actual figure in April 2019, and that would reflect what is the macroeconomic news being conveyed by the participants of the Bloomberg macroeconomic survey. Yeah, so now we then also control for the standard controls in literature like size, beta, leverage, book to market, return to equity, etc. One additional one that we included was because, as Jaideep mentioned earlier, through the Beaver's paper, we also control for a dummy variable for negative earnings surprise, because Beaver's paper had highlighted that the reaction differs for profit making versus loss making. So if there's a loss, investors react differently as opposed to when they react to profits. So these were our like standard controls over here. So I'll start off with my earnings announcement. So what we found in our earnings announcement data was that if you guys can see, during the normal circumstances versus like the pandemic period, during the pandemic, we did find the mean values as it was expected to decrease. But what was interesting was that the standard deviation had decreased. So as you guys can see, the standard deviation had decreased for the cumulative abnormal return around earnings. It went from 8.4 to roughly 7.2, and the same thing happened for SUE. SUE is like showing the earnings surprise, although all firms had faced this earnings shock. But we found the standard deviation to decrease over here. The mean value went down, but the standard deviation had decreased. That we saw. So then we said, okay, now how about we like model this over here? So this is our basic model, which using standard literature, we regress our cumulative abnormal return of earnings around SUE. Now, what we include over here is that we add an interaction term. We interact our SUE with the pandemic dummy, to see that what was the responsiveness during the pandemic. Did it increase? Did it decrease? We were trying to investigate that along with our control variables. One more thing that we also included, we used the Driscoll Gray standard errors. So the reason why we use these standard errors is that some studies had highlighted that during economic uncertainty periods, there is like cross-sectional dependence in our error terms, because all firms, let's say in our context, are facing the pandemic shock. We also did a test for cross-sectional dependence, and we found that there was cross-sectional dependence over here. So the advantage of these DK standard errors are that like not the do they only control for serial correlation, heteroscedasticity, but they also control for this cross-sectional dependence. So we included DK standard errors while running our regression. Now, our results were quite interesting. What we saw was that the earnings response coefficient, which we define as the beta 1, like I'm going to refer this beta 1 and beta 3 to be called earnings response coefficient. That's a standard name in literature, that how do markets respond to earnings. So what we saw was that the earnings response coefficient during the pandemic, which is SUEPP coefficient, that was positive and significant, and it was quite elevated. As you guys can see, it was around 0.21 when we included a standard control, showing that during the pandemics, investors were reacting significantly to earnings information. We also control for this negative surprise dummy that I had mentioned for Beaver, just to make sure that we're looking at all profit making firms. We're like controlling for loss making firms. So even after that, we like find a significant coefficient of 0.16. So what we can say, like what we found over here, was that there was an elevated earnings response coefficient during the pandemic. Markets were reacting significantly greater to earnings information as opposed to the normal time during the pandemic period. So this is the first thing that we found. So we said, okay, now if we know this, now let's try to understand this. So we'll also see the same thing for GDP news. Are markets also responding to, let's say, news, macroeconomic news in a similar manner? So we first looked at our GDP news data. Now, the interesting point that we found in the GDP news was that the news obviously went down. It significantly went negative, because we can expect that GDP there will be a negative GDP surprise. But we saw that the cumulative abnormal return, the responsiveness to GDP news, the standard deviation roughly just increased from 4.8 to 5%. It was not that volatile. So the market was not responding in a similar manner to the surprise, as opposed to the negative news that we had received about GDP over here. We also try to do one more investigation before we run our model. So in the Bloomberg macroeconomic survey, like because it's a consensus forecast, they have like forecasts given from like multiple participants. So Bloomberg also gives you the standard deviation. So we also looked at, okay, how is the standard deviation, because that will also tell us the dispersion amongst the market participants about the GDP forecast. So interestingly, if you guys see, during the pandemic, there was a significant increase in standard deviation. So even that also gives a signal that there was more information uncertainty surrounding macroeconomic news. Even like the participants were not that's certain about macroeconomic news forecast over here, and that's why there is this significant standard deviation increase that we find in this GDP news, which does not exist during the normal circumstances. Their like forecasts are roughly on a consensus basis, and there isn't much dispersion over there. So now we say that, okay, we have our initial understanding. Let's now run the model for this as well. So we also run another model for GDP news. We take our cumulative abnormal return, which is the return around this GDP news announcement, and we regress it on this news variable, and we interact it with the pandemic dummy. So now, firstly, we do find that the coefficient is significant, which means that the market is responding to GDP news. But we find during the pandemic the coefficient is not significant, so it's roughly the same. There is no change in the responsiveness to macroeconomic news, although we've already seen that there was this significant or elevated responsiveness to earnings announcements. So their responsiveness pretty much stays the same during the pandemic. They're not responding in a similar manner to earnings to like macroeconomic news. So we want to now investigate this further. But before we go ahead, we were also concerned that, okay, it could also be that maybe there is this bulk buying, or the fact that because of like market fluctuations, there is this significant card that we're noticing. Maybe that's like like something that's like overlapping with our results. So we also conducted a placebo test around our earnings announcement. So what we did was we took, okay, four more windows. We said, okay, how about we also calculate cumulative abnormal return 30 days before earnings announcement, 60 days before earnings announcement, 30 days after earnings announcement, and 60 days after earnings announcement, just to see that is it because there is a this average increase in car, or is this car only increasing around our earnings announcement. So we found that they were not significant. There was no significant cumulative abnormal return using our placebo test, which is -30, -60, +30, +60. So that at least gives us this significant cumulative abnormal return that we find, which is like centered around earnings announcement, is like significant, and that does make sense because it's about this information content of earning that we're trying to investigate over here. So, Jaideep, do you want to come in?
So yeah, so I mean, I think it's a good point for us to stop for a second and like summarize a little bit. So what we found is kind of interesting, because what we know is that accounting or earnings information, really, it was significant and more important during the pandemic, in the sense, and so this is really important, that the reaction to an earnings surprise, unexpected increase in earnings or decrease in earnings, the size of that reaction was bigger. And so essentially what we are seeing is that even though essentially the economic news became less precise, because the higher the standard deviation, the lower the precision, and we can see that it was clearly less precise from the forecast data that we looked at, and also what we expect from the pandemic. There was not much of a response to this economic news. So when it comes to different types of studies, people have tried to understand the decomposition of like what is important, what's not in stock prices. We're not doing that precisely, but what we're trying to do is we're looking at how people respond to actual arrival of news. And so in that context, we see that there's a very significant elevated response to news arriving in the pandemic when it's earnings, but not when it's the economic news, which is less precise. So what is it that causes this to happen. Like, why is firm specific information so important? We saw that during the pandemic, the market went up and down at different points in time. GDP forecast went up and down at different points of time. So it's not about any kind of trend that we are seeing here. We're just seeing like a higher sensitivity. And so maybe there's a couple of potential theoretical explanations that are consistent with this. So just to confirm those, we did a few further analysis. So that's basically where what are these going to present now?
Yeah. Thank you. So now to investigate this behavior that we've spoken, we wanted to see why is this increased responsiveness coming around. So what the argument that we use is about price informativeness. So like studies have shown that the informational content of earning, like how relevant that earnings news is, depends on how informative the price is. By price informative, I mean that before the earnings have been announced, were the markets able to incorporate information about the firm? There are like several channels what the market can use to incorporate information about the firm, which include, let's say, macro news, earnings forecast, let's say other financial news. So like markets incorporate these news, which is why we say that if prices are more informative, then the reaction to earnings will be lower, because the market will not respond in a similar manner to earnings if they have already incorporated this price. So we wanted to see whether prices are informative or not. So to see whether prices are informativeness, we use two like proxies for price informativeness as shown in the literature. The first one is size. So firm size is a proxy for informativeness, because investors usually find the earnings announcement for large cap firms to be less informative, because they say that that information has already been released. There are more disclosures, there are other announcements that are coming around. So at the time of earnings, large cap firms are less informativeness as opposed to small cap firms. So we took size over here. One more thing about size. Size also is a proxy for analyst coverage as well. We've also seen in literature that large cap firms have more analyst coverage too. So which is why we can say that their prices their earnings announcement are less informative. So we interacted size with both our variables, SUE, which is the earnings surprise, and the GDP news variable. Now, what we found over here was, number one, there was this inverse relationship between responsiveness and size, something which we already expected, that there would be a negative relationship between size and responsiveness. But we still found that our SUE into PP, this interaction of earnings during the pandemic, was still significant and like positive over here. We did see the triple coefficient, which is like pandemic, SUE, and size, to be negative and significant. But what this essentially told us that markets were also responding in a greater manner to large cap firms. So there was this elevated ERC around large cap firms as well, not just for small cap firms. So they were not able to, let's say, during like similar time, they were not able to, let's say, incorporate information. This is what we think, where they were not able to incorporate information for large cap firms as they were able to do during like normal time. So I think to explain that, we drew this margin plot where we looked at the responsiveness to like different size firms, to like earnings, and to our GDP news. If you guys see during the for our earnings SUE during the pandemic, we can see that there is this significant responsiveness, higher responsiveness during the pandemic for all firms, especially including large cap firms as well. So we found that even like large cap firms and small cap firms, all of them had a significant responsiveness to earnings during the pandemic period. Whereas when we look at the responsiveness to macroeconomic news, we see a diminished responsiveness. All right, so their responsiveness is very diminished over here. They're not reacting in a similar manner as they're reacting to earnings. So that was our first thing that we saw, that even large cap firms were also responding and had an elevated ERC. So that was our first proxy to understand whether prices are informative or not. However, we also did one more test for informativeness, which is we looked at stock price synchronicity. So stock price synchronicity has been is another proxy because it looks at this R square of this market model that we all know about, which is like regressing returns on the market index. We just take a logistic transformation of it. So stock price synchronicity will essentially tell you whether markets are like following more about the index, or are they like, relying more on firm specific information. So we follow prior literature, we use daily returns, and then we calculate quarterly synchronicity. What we find is that the stock price synchronicity has increased during the pandemic. So relatively, there was a greater stock price synchronicity during this pandemic period for our sample firms. Now we said, okay, how do we explain this? So like, what justification can we do? So we started with Morketel, which is who introduced this concept of stock price synchronicity in like a lot detail. So we argued that this increase in stock price synchronicity can be attributed to this macroeconomic uncertainty, because that paper argues that when markets are highly volatile, then the market fundamentals tend to outweigh firm specific variation. What this essentially implies is that during economic uncertainty, it just makes it very difficult for markets to forecast future firm performance. So like during normal times, markets have sufficient information and there is less uncertainty that they can forecast future firm performance. So there's this increase in investor uncertainty. So how we explain our elevated ERC is that because there was this increase in stock price synchronicity, there was this increase in investor uncertainty. So what earnings announcement do is earnings announcement helps us to reduce investor uncertainty, which is why markets are looking at earnings announcement, because it will help them forecast future firm performance. Something that this increase in stock price synchronicity implies that this uncertainty had already created for them over here. So if I can say, we have these two proxies for informativeness, size, and stock price synchronicity. They both imply over here that prices were less informative, but the informativeness of prices had gone down. However, we still wanted to investigate this further about our macro news. So what we did was we did a quarterly analysis first. So we said, okay, we have like 5 quarters in our pandemic period. We started with 2020 quarter two, we went to 2021 quarter two. That's like 5 quarters. So we said, okay, how about we see what's happening in every quarter? Now we find that our results, which is an elevated ERC and a muted, let's say, an unchanged responsiveness to macro news, was found in these 3 quarters, which is third quarter 2020 to the first quarter of 2021. All right, so we find that these 3 quarters are where this elevated ERC is found. So we said, okay, how do we explain this? So what we did was we like said, okay, we need to follow somehow the economic risk in the economy. So we extracted from Fitch Connect this economic risk index. So they report two different sets of economic risk index. One is the short term, one is the long term. For their short term risk index, what they do is they just quantify the current vulnerability an economy is facing. Whereas for the long term index, they look at, let's say, historical data and their forecast, but they do it over a longer term period, like let's say 5 years. So we said, okay, let's follow these indexes. Let's try to understand what's happening during our period. So as you guys can see, during the pandemic, there was, as expected, there was this significant variation, like during for the short-term index. Just one more note: this index operates like this. It goes from 0 to 100. 100 means that the level of risk is lowest. 0 means the level of risk is highest. So if there's a decrease in index, it means that the level of economic risk has gone up. So we saw that there was a significant increase in the short term index because it's like capturing the current vulnerability in the economy. So interestingly, what we found was that our elevated ERC and these two indexes, they were like pretty much aligning. They were also moving around a similar period. So we said, okay, let's try to examine this. That can this help us explain this reaction further? So we said, okay, now we've seen elevated ERC. Let's try to also look at our GDP news variable. So what we do is we take our similar regression again, which is like our cumulative abnormal returns around this GDP news and our news variable. We interacted with our short-term economic index. So we first did a test. We saw that okay, for cumulative abnormal return around GDP news, which one is like relevant? We found that only short-term economic risk index was like significant, which does make sense because these are quarterly GDP surprise. They're like more concerned about our short-term economic risk index as opposed to long-term. So we took this short-term economic risk index, we interacted it with our news variable and our news into PP. So what we found is that, let's say during our normal time, if you guys can see, our coefficient was 0.14, which means that when the index has gone up, which means the level of risk is low, and there is this positive GDP surprise, we can expect a significant and a positive response to GDP, which is fine, which does make sense. But what is interesting is what happens with this triple interaction term, which is news, STERI, and PP. During this pandemic, we see that this responsiveness almost becomes zero. So it was 0.14, now it's roughly minus 0.14. So what that tells us again is that markets were not responding to GDP news during the pandemic, maybe because they found other relevant information. So the responsiveness was low to this GDP news surprise. It did not respond in a similar manner as how significant earnings had become. Finally, we also did some robustness check just to make sure that our results are valid. So we did multiple robustness checks. Number one, we looked at our earnings surprise from their website as well, because we had all the earnings data from data stream. We also mapped it against their website just to make sure that there isn't any significant differences, because sometimes what happens is that the day earnings is announced, it might get sometimes revised. So we try to align that. We also looked at any confounding events, which is that, let's say during our earnings announcement, or even GDP announcement dates, there was this other event happening that might have collided. So we also removed those events, and we saw that okay, are there any like confounding events? We use buy and hold abnormal returns as well, because like some studies have argued that buy and hold abnormal returns are better than cumulative abnormal return because they take a geometric average and it's like more investment aligned. So we said, okay, let's also use buy and hold abnormal return. Can we see our results are like validating or not? And our results were valid. Finally, there was also this endogeneity concern. So we had two endogeneity concerns. One was that our SUE, our earnings surprise, might be an endogenous regressor. There is this fluctuation or this sentiment that's impacting both CAR and our SUE as well. So we did a two-stage least square where we took industry SUE as our instrument variable. We also had another concern that it could also be that past abnormal returns are influencing, let's say, our current abnormal returns. Firms might be trying to meet expectations. So we did a two-step GMM over here. Our two-step GMM also validated our results. We did not find like a lag car explaining current car, which like tells us that okay, this was happening at the same time, and their like markets are somewhat also showing to be efficient over here. So using this, what we can conclude is that there is this debate that's in this literature that shows that, okay, has the information content of earnings, has it increased over this time? Has it decreased over this time? Some studies have argued that, okay, the relevance of earnings has gone down. There's this other information source. Some studies still say, okay, earnings are relevant. So we demonstrate that the responsiveness and the relevance of earnings has increased. How we explain our result is that since the quality of information from alternative sources, one we have already illustrated, the quality of information from other sources that diminishes during this period. So like markets know that the quality of their other information is low, that increases investor uncertainty. Now if there is this higher investor uncertainty, the relevance of earnings increases for like valuation purposes, as firms would want to know about how this impact of economic environment will affect the future financial performance of the firm. So in this context, the relevance of earnings has increased. That's how we explain our results over here. So that is it from my end. Thank you.
Okay,
Ali.
thank you. Thank you, Ali. Jaideep, you want to say something?
No. So I was just
Okay.
yeah.
So thanks, Jaideep and Ali, and particularly Ali, who did the majority, and you explained very clearly. And I think I would keep my questions until we do not have any more questions from the audience. So can I now open to colleagues whether we have some questions? I'm sorry, I said something that I should not said. So no, I do not. So guys, come on with questions here. No? Okay, let me start, and then we gradually get into somewhere. So very interesting actually to me. And I saw a lot of accounting things. And I'm not an accounting person, so maybe my comments are not that correct. But I have two concerns. The first one, your main conclusion is when there is a high uncertainty, macro level economic news will lose power in terms of their informativeness. Therefore, investors pay more attention to firm level earnings, for example, earning announcement. And you use the COVID to prove this. So I think you only use the COVID if your conclusion is valid, and if you want to make a contribution in terms of the whole, theory or literature, you probably need to check whether or not the conclusion is still valid by using some other crisis. For example, does your conclusion apply? It still, exist for the period for global financial crisis, or for some other, crisis? So because you argue this, you need more. For me, yes, maybe during COVID, maybe COVID is different from other crises. However, if you are arguing this is something that you are proposing, then you are documenting, then probably we need more the similar test, but use another type of crisis. So that's my first concern. Secondly, I was thinking, how did I respond to crisis, to news? I would say if there is a lot of uncertainty, more higher uncertainty, I would trust more of the macro level news rather than firm level news. Because people need a kind of a direction in terms of the whole, market, where the market. It's not about any specific firm. I know there is a literature that you already put forward, but probably I'm not familiar with that literature. But intuitively, I'm thinking if I'm an investor, as a normal person, if I see more uncertainty, I do not see clear the direction, I do not know what the next year will be, I trust more of macro level news rather than firm level news. So I wanted to have a little bit more about this. So how do we, if there is apparently this is a behavioral thing. So what are the behavioral elements here that can explain this? So that's my second concern. And my third one is about your theoretical underlying theory. So I think you mentioned something, but I need to see a little bit more underlying theory and in a more explicit way. So so that I can be grounded more. solidly. So let's say, so that's my comments.
Thanks, Hong. So in fact, I think especially your first two comments, and by the way, Kemi has joined us as well, and Tolu I can see online. So they can also chip in if they like. But the especially your first two comments, they're really important, and I think that's a question that we have to be very clear about. So we're not saying that macro information becomes less important in that sense. So for example, we know, and if you look at other crises, for example, which is the question you were asking, macro information is very, very important, right? But those are endogenous financial type of crises. Here, what we're talking about is the quality of the information. That means there's uncertainty about the macro news itself. So it's the precision of the news that's gone down. It's not just the fact that the GDP is going down or up or we are in a crisis, but it's the precision of the information that is causing a different reaction. Now, the fact that the stock price synchronicity is so high during this period suggests that actually people are doing what you say, which is that they are sort of allowing generic information about the economy to drive their overall portfolio. But every time an earnings announcement comes out, there's a resolution of information, and that's where the heterogeneity across firms in the cross section becomes more apparent. And so the reactions as a result are much bigger then, because the information suddenly has a greater sort of salience, because it's uh, it's firm specific, and it's something that maybe can, like, let's say, differentiate the firm from the aggregate information. So it provides information about the specific earnings profile of the firm as opposed to the overall economy. Because one of the types of uncertainty that is coming about here is the ability of the GDP to explain the earnings of the firm. Before, normally, you can use GDP forecast to tell you what the earnings of the firms will be in the future as well. But when that information becomes sort of unclear, because you can't rely on the GDP forecast first, and secondly, the GDP forecast relationship with the earnings of the firm becomes even more sort of unclear. Then the earnings of the firm become important, and that's why we see a response at the time of the announcement, not at all other times. So firm specific variation is actually reduced. So the firms' stock prices move closer together, but they respond more on the date of the earnings announcement. And that's kind of so that's how it reconciles both the arguments. So your first question and your second question, they're flip sides of the same thing. So we don't say at all that macro news is less important. In fact, it is more important. But the earnings actually sort of resolve a great deal of sort of information or lack of information at the time the announcement is made. So, like Tolu was asking us yesterday, what's a policy implication of this? And that's where like if you think about a regulator, they're more likely to be let people relax a little bit with their disclosure standards during crisis. But this suggests that the opposite should be the case. So you want regulators to be even more sort of stringent about disclosures during a crisis rather than the other way around. So so the message is not that earnings are more important. It's just that the people respond more to earnings when the news comes out.
But do you see the point that you can try based on other types of crises, yeah. Because you did not really focus on the specific features of COVID. Yeah, if so you do, yeah, I accept. Yeah. But you do not. You just use this as a kind of a case. So that should be, if your conclusion is correct one, then that should be applicable to other crises as well. So that's that's my
Yeah. Thank you, Hong. So in fact, I think we have to be a little bit more clear about that in the paper. So a lot of people have actually found that this is not necessarily the case in other crises, and that's really important because if you think about the typical financial crisis, it's in that type of crisis, this type of uncertainty doesn't exist. What happened in COVID?
Yeah.
So that's the big difference, because
That's very
everyone is
good.
uncertain.
Then you should say that.
Yeah,
You should
yeah.
say why COVID. Yeah.
Yeah.
So
yeah.
what are why COVID, especially COVID, made the macro level news, more uncertain, more weak. So that should be. So Tulu, I want to escape from my questions. So Tulu, I see your hand.
Yes, I just thank you, Ong, and perhaps a bigger thank you to Jaideep and Ali for a brilliant presentation. I just wanted to chip in a little words. Yes, we take your suggestion to improve on the theory. We take it on board and we'll look at a greater story so that we can connect the analysis that we have conducted. I go back to the argument relating to the supremacy of earnings news and economic news. I think I want to agree with you a little bit, especially from the point of view of econometrics. Okay, we have presented two models, okay, which are standalone on their own. We presented the model for earnings, and we also presented the model for economic news. Perhaps we should go back and look at the possibility of presenting one model that will be able to test how dominant one variable is relative to each other. For example, this question we are asking whether earnings dominate economic news. If we have the two variables in the same model, we'll be able to answer that question in a concrete manner. So I think as it is now, we have used two models, and these models, if you look at the presentation, they have different observations. Okay, one is 1,000 plus, another one is 4,000 plus. Perhaps we may be attacked on that front. So we'll go back and look at the possibility of producing one model that will be able to distinguish the superiority of one factor over the other. Thank you, on both. I also wanted to mention some minor issues. Ali, I think this is something that we can easily correct. In terms of the table, when you presented the measurement, okay, you told us that the measures are from data stream. Yes, we know they are from data stream, but there are various measures on data stream. So we want to know what measures you use, for example, the return on equity. I think I picked 2 or 3 variables there that you did not give us the definition of the variables. You only told us that they are from data stream. I think it's better for you to give the definition of the variables. Yes, I think, again, thank you, Ambu, for your feedback. We'll look at ways of improving the paper.
Okay, thank you very much, Tolu. Sandrine?
Yes.
Yeah.
Yes. Hi, everybody. Yes, I'm not familiar with this literature, but I have one question. During the COVID, some companies, all the companies in the sector of electronic trade, used to grow and to make. I mean, it was like something positive for them in a way that people use their service. So I would like to know how you integrate this in your analysis. Is it relevant? And because I don't know, but this is a question that I'm asking to myself. Thank you.
Thanks, Andrina. Thanks for your question as well. So indeed, I mean, that's kind of one of the reasons why we feel that we can sort of justify analysis. Like our focus is on the earnings element, and so there was a huge amount of heterogeneity in firm performance, firm earnings, but also firm prospects. But there was just as much a high level of uncertainty about the future earning streams of these firms. So if you look at Zoom, right? Zoom came from nowhere and became this amazing company. Of course, fortunately or unfortunately for us, we don't have Zoom in our sample because we're looking at British firms, which are mostly old economy type firms. But indeed, there was a huge amount of heterogeneity in the firms. And for example, I gave the opposite example of real estate, commercial real estate. Warehouses became extremely demanded, but offices became completely useless. So if you're looking at that kind of variation, then again, the actual cash flow news, as opposed to the sort of the rough projections of people, become really important. So how much, like, what are the actual earnings of the firms as opposed to all the other sort of, speculation that's out there? And in a way, what we are capturing is this, on average, when the earnings are different than you would sort of predict from a standard random walk model, then people are reacting more to those earnings. So it doesn't matter which industry they belong to, because across the different industries, they have different levels of sort of positives and negatives. And so the size of the reaction is big, whether it's a negative return or a positive return. So I don't know, Aliya, maybe before Kiran asks his question, do you want to tell Tolu what return on equity? I mean, I think he obviously knows it, but just because I think he wanted us to share it with everyone. So maybe you want to share it with everyone.
Yeah, so
Yeah,
like we like calculated that from the variables that we got. So we like followed standard literature. We looked at the earnings that were announced, and we like divided that by the equity figure we had, because we also had their equity figure. So most of them were like calculated. I think in the actual paper I've given the definitions at the end, but like in the presentation I just like listed them down. I did not give the definitions over here. But yeah, they were like
So what are the items? Let's just tell everyone what the items are. So the items are basically
profits, like the
profits
earnings
divided by
the equity value. Yeah.
Sorry, Hong, do you want to, should I let Kiran go
that's okay.
next?
Tulu, you have something to add,
yeah,
right?
not now.
No. Okay. Ali, do you think you are satisfied with those supervisors' responses?
Yeah. So like one thing, just if I can quickly just like say one thing over here. So like I think just to address one of your comment, and I think people must be thinking. So like it's not just that macro news is not important. The idea is that investors use macro news and other news. They use that to like forecast future earnings, which is why at the time of earnings announcement, like during normal times, we can say they already have, let's say, macro forecast, they have, let's say, earnings forecast, they have other news, and they're able to forecast future earnings. What COVID did in our scenario was that this information quality that we're like talking about, that reduced over there, which is why they were not able to like predict, let's say, future earnings, which is why their significance increased on the announcement date. That the announcement was actually helpful to them to like forecast future earnings. So we're just trying to show how during normal times markets, as shown in like literature, are using other news channels, but during like the pandemic, the significance of earnings increases, which is why there is an elevated ERC across all firms. It's not just an industry specific phenomena over here. So that was just to explain your initial comment, and now I think I'm going to take few more questions.
Yeah. So that's really good. So I saw two hands. Kieran is the first hand. Kieran, hi.
Hi. Hi, yes. A hugely impressive paper. Thanks very much. I'm sure I didn't understand all of it. And I'm not a financial economist really, so my questions are pretty basics. But if you, I suppose the answer to the last question probably is relevant to this. But why should the stock market care about current earnings? So stock market is presumably concerned with the value of the firm, which is the discounted sum of future earnings. So then if you're looking at the responsiveness to current earnings and how it might change between one period and the next, you might be concerned as to whether, and this was, I think, just what the recent comments were about, whether present earnings can predict future earnings. So did you, and I may have missed this, did you have a time series analysis of the characteristics of present earnings on future earnings to see if there was a structural break during the pandemic? So that was really one of my questions. The other question was, I think also there was some discussion of that just now in the recent comments, but about firms and sectors. So the idea that there is more attention being paid to the firm, I mean, it kind of makes sense if the macro information is of less discernible or less useful. But would it be accounted for by sectors rather than firms? Would be something I would think about. There's a third question, which is about the exogenous uncertainty of the market. Is something that connects with real options theory, I suppose. So typically, you would think that that kind of uncertainty would actually raise valuations, and don't know whether that's taken account of, because that would differ between different types of firms, say growth firms and value firms. And my only other comment was on the GDP surprises. So I think that the GDP have got 3 different releases, and the surprises are often calculated in relation to the first release, so that they're not really a surprise in the sense that the second release may have occurred by the time that particular action is taken. But I'm not sure how you dealt with that, but it would have relevance for the regressions that included the GDP surprises, I suppose.
Yeah.
Anyway, thanks. I'm sure there's lots more to discuss. I think there's probably some stuff about whether whether in terms of the overall market, the overall financial market that spanning continued to operate during the crisis, when the crisis itself may have interfered with the concept of what the actual market was, by changing the composition of the market, in which case you wouldn't expect the normal rules of finance to apply. But that's a rather deep and difficult question. It probably belongs to a different discussion. Thanks.
Thank you, Kieran. They are very, very good comments. So who is going to respond?
I can start, and maybe I'll ask Ali to come in on a couple as well, if it's okay. So first of all, Kieran, just to expand on what Ali said earlier and what Hong said and we discussed before in terms of the earnings, the valuation question, right? So why do earnings matter for future earnings? So in a very sort of intuitive sense, think of it this way. Like if you think of PE ratio as a kind of a useful notion of valuation, so you're sort of something that things move towards, in like on average or whatever. Let's say at least some adjusted version of that. You're thinking of the valuation as the price as being some feature of an expected stream of future earnings. Now the thing is that if your price is constantly adjusting to your expectations about the future based on your projection of GDP information, other economic information on the earnings stream, your updated value of future expected earnings, if it's constantly adjusting, then you're on the date that your earnings announcement comes out, the additional information content in that earnings announcement will be relatively sort of, if it's consistent, it'll be a certain amount of information, will be as a surprise element, which people will respond to by adjusting their entire stream again of future expected earnings by the extra information that they get. Now, the question is that information, that extra information, a lot more or a lot less during the pandemic? And what we find is that that information is a lot more because the size of that response at that time to this news is bigger in the stock price adjustment. So that's why what we can see is that somehow the update on the earnings is poorer prior to the announcement of the earnings, and on the date of the earnings, therefore the response is much sharper. So that was the first question. I don't know, I hope I'm getting closer to the answer to your sort of thing about being able to predict future earnings. Now, that's why it's not important that we're not looking to see whether today's earnings can predict future earnings in any different way or not, or whether there's a break or not. It's simply about how the price responds. So that's linked to your other question about valuations and about the theory around what happens to risk, right? So the fact is that so this Veronese paper that we cited, for example, from the Journal of Finance, it's of course it's believing in only one asset. Okay, so it's a Lucas tree type of model. But if you take that intuition forward, what it's saying is that supposing you get an earnings announcement today, a dividend announcement, and that's the only piece of information you get about the future, because your information about GDP forecast is useless, then your response to that earnings dividend announcement will be to use that as the only update that you have. And so that's why this is not behavioral, this is Bayesian updating about all future dividends. Whereas if you had a very good idea of all future dividends because you had an excellent idea of the future GDP, then you would not respond that much to this particular dividend surprise. Because no matter what the dividend is today, it's not going to generate a new sort of set of future expected utilities beyond the small surprise that is present for today. So your consumption will vary more with your returns, but not the prices of the assets. And so that's where the theory comes in for the valuation. And so I think in terms of the GDP surprises, I think Ali can explain a little bit better. But basically we have we're not using. Sorry.
Just quickly,
you want to answer that
are you
question?
saying that it doesn't matter what the coefficients on future earnings are of present earnings in a time series?
So in this context, no. In this context, no, because we're not looking to see whether the forecast whether we can forecast better or not. What we're looking to see is
no, it's not whether you forecast better. It's whether the coefficients differ.
Yeah. So no, I understand what you're saying, but the point is that it would be okay, let's put it this way. If past earnings were perfect predictors of or similarly predictive of future earnings throughout the time series, okay, the extreme case where there's no difference, even then people would react more to the earnings surprise, because even that predictability by itself does not change how important the response is to the earnings. Because let's say that because the earnings surprise itself provides some information. Now that information is more important for you because it's the only thing you rely on to predict the future earnings. Before, you relied on that and 100 other things. So that's why you react more to it. So it doesn't matter how well it predicts in the future. It was the same prediction or different prediction. It doesn't really matter that much.
Supposing the pandemic halves the horizon time of all firms.
Okay. So I mean, if you those are like much broader questions. I think that they're beyond our ability to sort of cover from this point of view. But just in terms of whether the earnings can predict future earnings differently during the pandemic or not. That could, if the predictability reduced, that would be a problem. In the sense that then you would have to think about why people are reacting to the earnings in the same way. But the thing is that during the course of the pandemic, you couldn't have possibly known what would happen to future earnings with respect to past earnings. So if you use the same kind of rule of thumb or sort of expectations based on the historical pattern of earnings, then you should be able to you should be able to see exactly the kind of reaction we see here, which is that the incorporation of the information from the earnings is sort of the most important element of the entire future stream of earnings, and that's why it's leading to a greater response to the news.
Okay, let's hear from Ali and Tulu, and then we give the floor to Kemi. So any other addition?
Yeah, so I think one question was about the GDP release. That's a very good question. I didn't write it in this slide, but it is addressed. So the Bloomberg survey gives out two GDP releases. One is called the provisional one, the other is called the forecast one. We only use the provisional one. That's the preliminary, the first information that's given, which is like the news, because our earnings is also like the first news that comes out to like make it comparable. We use the provisional forecast over here. Then they also later update that, but that wouldn't be initial reaction, so we try to make it comparable, so it is the provisional one. But like but I really like this question that you picked up anyways. Secondly, so what your question was about, just like to conclude, I think Jaideep has explained it. You're like talking about we call this earnings persistence, that the ability of earnings to like predict future earnings. But like the argument over here was that where we started off, that even during normal time, let's say even earnings are highly persistent, but like markets were looking at other information just to forecast future earnings. So which is why studies have been arguing that the relevance of earnings has decreased. What we're trying to see is that, okay, people have this argument that, okay, relevance of earnings has increased because they get other information set that helps them do the same thing that earnings can do, which is forecast future earnings, which is like useful for like valuation purposes. So like our argument is that during the pandemic, what happens is that the quality of other information sources decreases, which is why people are relying more on earnings, which is why we see a higher responsiveness. We do not go into this that, let's say, they're responding high means that the earnings are like highly persistent. We don't go into that analysis. We're just looking at the market reaction over here. I think Jaideep explained that just to like summarize this discussion. Hope like that clarifies.
So, Kieran, can I move on to Kemi, or you have something
Sure.
to add?
Sure.
Okay, thank you. But thanks, a very good discussion. That's what we need, right? So, Kemi, I see your hands, but I did not see your face. Kemi, are you okay? Everything is going well, right? Yeah. Okay, good to see you. Yeah, please. Yeah, thank you.
Good to see you, and good to see everyone. I actually wanted to just show my face as just like you requested, and also to see everyone and for you to hear my voice. Just to say hello to everyone, and to say I miss this this gathering, this seminar. Even though I've always wanted to join, but it clashes with the seminar at Aston as well. That's why I have not been joining. I have to specifically join this one because of my interest in it. And maybe I should just add just a few comments with regards to your point, Hong. When you said about why not try another crisis rather than the pandemic. So I just wanted to, it's an interesting point you raised there, because, the pandemic is a global crisis. And even though it didn't start off as a financial crisis, but, because of the duration of it, it ended up affecting everywhere, affecting the market, affecting the health system, and so on. And another thing with the COVID is, because it is global, it then turns out that in the market, everyone is on a level ground. I mean, we're all operating on the same consistency across the world. So for example, the risk-free rate that you would we could have said, okay, is one of the things affecting the earnings in the UK, turns out to be, the same all over the world. So it would have been interesting if we are able to use another crisis that is peculiar to the UK, just as a robustness check to say, okay, what if it is not a global crisis? What if it is a crisis that is, focused on the UK itself? For example, Brexit or something like that. Will the result be the same? So I was just, when you mentioned that point, Hongbo, I was just, thinking, reflecting on that, and I thought, what a good idea. If we could identify a crisis that is peculiar to the UK and maybe use that as as a way of comparing to see if the result will be the same if we use the global crisis. Yeah, just that's just the comment I would like to make. But I know, for this particular paper, I think our interest is just on earnings announcement, not really on the the type of crisis and all that. But it will be an interesting study to see if it will be the same result if another type of crisis is used.
Yeah.
All right, that's what I want to say.
Thank you very much, Kemi, and good to see you. I really like your, actually you were, clever in putting forward this, pandemic is worldwide, global, so everybody, we do not have the discrimination. So,
Exactly.
but that's good. That's a good point, actually. So, thank you very much, Kemi. I see, Tolu, you would like to add something, right?
Yes, I just wanted to come in response to Kemi's suggestion. We actually discussed this issue yesterday at our brief meeting, and we considered the issue of Brexit. But if you look at our sample, okay, the study period, you see that it also covers Brexit. So to disaggregate the impact of COVID to disaggregate the impact of COVID and Brexit when there is an overlap may be a little bit difficult. In fact, we also looked at the possibility of the Ukraine and Russia war, and that happened post COVID. In fact, it was as a result of COVID, partly as a result of COVID, that we are having the Ukraine and Russia war because of the supply chain disruption. And our study period covers this three events: COVID, Brexit, and Russia-Ukraine war. Perhaps there's a way we can account for this from the point of view of econometrics, but it will be a bit difficult for us to do a separate study.
Correct.
Yeah, maybe, but you can think about a higher frequency data. So now you use the, maybe quarterly, right? So you can think about monthly, daily. So therefore you still have a lot of observations. Even the window, the event window is a little bit shorter than COVID or something. But that's just. But I see the point. So, do we have any other, including the authors, do you have anything to add, or from the audience, do we have any other questions? You know what? I think it's very good to see that this is going on, and that's very very good project. I'm still thinking about the theory. So in my mind, I have two things. So yes, you emphasize the accuracy of something under high uncertainty. To me, this is the efficient market hypothesis thing. And rationally, people are reacting to the things that has a fundamental substance that are related to the real economy, et cetera, et cetera. And for me, during the high uncertainty period, the behavioral things become extremely important. So we saw people are speculating, people particularly, you see, I saw you have something like synchronicity, right? So
Yeah.
the stock market, you saw lots of the things like that. To me, it's a herding behavior. Investors are hurting because they do not know what they want to do. And they do not really trust the information, the concrete information that they have. They just follow the herd. So I'm struggling in understanding what exactly the theory this is. So you actually overemphasized the hypothesis, the efficient market hypothesis. But for me, I'm really, I mean, yeah, I'm not that kind of speculator, but I think under uncertainty, particularly during that very extremely uncertain period, I think you see the bond market, the stock market reacted dramatically. The volatility was so high. Why not? Why is that? People are hurting. People are speculating. So I just want to, I do not know whether you have the response, but I'm still not that convinced. So I'm still thinking if you put this behavioral thing, linking that with uncertainty, whether or not you still have your story, whether or not you can still convince people.
That's a
And
really good
that's
point.
my
Yeah, thanks for that. I mean, in fact, if you think about, so basically, whether a herd is rational or not, that's like the ultimate debate, right? So we have, like, for example, this kind of synchronicity models and other kinds of models about the sort of stock dispersion. Both the behavior and the rational people claim that it's consistent with their theory. So based on whether you have an information argument and an updating based on Bayesian learning, or whether you have an argument which is based simply on some kind of mimicking behavior and so on. But both the theories can generate the same outcomes. So that's part of the problem. That's why it's observationally equivalent in a sense. So I completely follow what you're saying. I mean, if it is the case that people are just herding, uh, then someone is going to make a lot of money if they know that the people are making mistakes. But what we find is that the reaction is very big, which suggests that the market has to be efficient to an extent. Otherwise, this reaction would not be so big at the time of the new information being released.
Yeah.
So it's almost as though the kind of the behavior, so the outcome is partially consistent, maybe like more consistent with an rational learning argument than with a completely behavior oriented argument where it involves mimicking, which is not to say that the mimicking isn't taking place. What could be the case is that the mimicking could be exacerbating this exact specific phenomenon. So it could be what's generating the synchronicity and therefore this massive reaction. So you have both things coexisting in that case.
okay. So Alberta, wow, Alberta, you are coming in now. Finally, come in, please. Yeah.
Just a thought, Hong, which has been triggered by your reflections, and if I may add one more bit of speculation, because what was coming to my mind is that in periods of crisis and uncertainty, I tend to think individuals may have kind of a hierarchy of credibility of sources. And when it comes to uncertainty, this hierarchy can be either reshuffled or some sources which are more reliable than others become just more prominent. And so there could be kind of a weighting, relative weighting of different sources of information, or potentially completely different sources of information which are taken on board, like health forecasts or geopolitical forecasts, for instance. And so I don't know how this fits in between a bit of behavioral argument and rational choice argument, probably, because it is behavioral, the choice we make regarding which source to trust, but it can be quite irrational in the extent to which we may grant one source more credibility than another one.
Yeah, I see what you mean. So thanks for Jaideep for your response. If that is the case, I didn't read your paper yet, but do you think that if you have a section in which you explain those different arguments, different theories, and then I do not know whether you need a hypothesis, but you need to provide people with different hypotheses, and then you test, you use your evidence to say sometimes this is dominating, so etc. So I do not know whether the referees are going to ask the similar question, but if I'm reading this paper, I think I would ask this similar questions. So it's just a thought for people to think further and to think about the how to make it more let's say so well-rounded. So consider all different possibilities, and then you focused on something that you have the evidence to support.
Yeah, that's really helpful. Thank you. And thank you, Alberto, as well, for like sort of highlighting the idea of credibility. So maybe we really need to, it sounds like we need to sort of explain the theory a little bit more quite clearly. I mean, like in terms of just how we come to this sort of hypothesis. I mean, I'm always hesitant to state hypothesis after running regressions, but then in this context, I think we're a little bit okay, because we've got some really sort of very like well developed theory arguments which go in both directions when it comes to a crisis in general. But there's only one set of theories that's been written about the quality of the information, and those predict what we see. So that's kind of reassuring. So we just have to make sure we put that down clearly.
Okay, so I really enjoyed the discussion, and I hope colleagues too. But we should have more questions. Colleagues, do you still have more questions? Okay. Karen, thank you, Karen.
I just want to just add one small thing, which is that I looked at Netflix stock price because I was using it in my class, and I noticed that it zoomed up in the pandemic because everyone was sitting at home on the sofa watching TV and so on. And then after the pandemic, it came down sharply. And I mean, this is only a sample of one, but my guess is that the notion of an efficient stock market looking forward with an infinite view is complete nonsense, and that stock markets operate in a short-termist way. But would that have any impact on the way that you would look at the paper, depending on which of those two ideas were entertained?
In fact, I mean, and again, it's the same thing. So thank you. And this example is great because like it kind of highlights the extrapolative nature of earnings information. So essentially, whether the market is efficient or not, or rational or not, like whether there are rational expectations as opposed to rationality, I think that's a separate, that's the kind of argument you're talking about, whether earnings are actually predictive of future earnings. But there's an extrapolative feature to it, and like people are, that's where the behavior argument comes in, I suppose. Maybe people's estimates are not perfect. They just think linearly and forecast way out into the future based on past growth. But if indeed they are doing that firm specific and they're not thinking about the whole economy or not thinking about the general equilibrium outcomes, then this is the kind of reaction that will come out. So again, they're overemphasizing firm information and reducing the reliability on all other sources of information. So you would expect to see a heightened response. Now, whether this is particularly the case for Netflix or not, I don't know, because I think there were a lot of stocks where you had like either they all went up, or there were a whole bunch of them, as you mentioned earlier, with industries and sectors that all went down sort of unreasonably. So we're not thinking about that aggregate variation. In fact, what we're saying is what happened, how do they change when some new information comes out about the specific stock? And so, I don't know if maybe Ali wants to add something. Oh, Tolu has also raised his hand. So Ali, maybe you want to switch off the screen so that we can all see each other. So.
Yes,
Tolu, please, yeah.
Yeah, this ongoing discussion takes me back to the measurement of car.
Mm-hmm.
The idea of non-synchronous trading, which is a possibility during the pandemic, especially given the sample that we have, FTSE 350. Okay, this is a mixture of big firms and relatively small firms. Okay, and when there is crisis, there is a tendency for investors to move towards the bigger firm at the expense of smaller ones. And when this happens, this might confound our car measurements. Okay, so perhaps we have to go back to the measurement of car and the testing of the significance of car for we call it team trading in an event study, how this affects not only the calculation of car, but the significance of car before we start explaining the variable itself. So perhaps we have to go back to the literature and see how non-synchronous trading or team trading can affect our results. That just came to my mind in the course of this discussion. Thank you.
Sorry, one thing. Two like comments. One is for non-synchronous trading. One of my controls, if you guys saw, I had taken that daily abnormal trading volumes as the control pre-announcement as well. That was done in literature, so I've taken that as a control. I didn't take it during my car calculation, but that's one of the controls in the model. Now, one more comment about Netflix. Now, this is my general view. There's a difference, like while doing the study about the US and the UK market. For the US market, firms are supposed to also release their 8K forms, which means that if they have any information, they're supposed to release that within 4 days. In the UK market, there is no such regulation. So, like, like going back to my story, that what investors in the UK, they can rely on alternative sources, or they have to wait for earnings announcement. There is no pre-information that is communicated to them on a firm level. But in the US, you will find different firms, like let's say giving out 8K announcements and everything coming out. So there is some sort of information that is being released over there. Secondly, the US and the UK, I mean, this is an accounting debate, but that's a rule-based system. What IFRS actually allows us, which I've argued, is that it allows them this managerial flexibility. So you can expect this variation in information content. Managers have this flexibility for IFRS setting, whereas in the US, in the rule-based setting, there is this flexibility, but it's less as opposed to there. So I mean, there are these two differences, I would say, looking at the US market versus the UK market, which is why we think UK market gives a better setting to analyze this variation in information content. Yeah, just
Great. Thank you very much. And thanks for all the questions, all the responses.
Yeah.
I think the purpose is to stimulate more questions. So, and then we continue to think about, what we have done. And this is why we need this type of activities. So if there is, actually we are doing very well today. So it's almost 2 hours. We had the whole morning activities for me, so I'm already very tired, but I'm satisfied. I'm satisfied with today's discussion, and I hope my colleagues in the audience, I hope you have something that you found interesting and informative. And let's do this, let's continue the discussion, even offline. Okay, thank you very much. Thank you, everybody. And thanks for the authors, for the presenters, for all people who contributed to the questions.
Thank you,
Okay.
everyone. Yeah.
Yeah,
Very
okay.
helpful.
I'll
Thank you.
see you
See you.
next time. Bye-bye.
Bye.
Bye.